it's important to also think about not just how much money you need right now, but what you'll need in the future to grow. Because investors, if they want to be able to maintain their percentage ownership, need to participate in each round of investing, or want to. But if that means, as an investor, I have to, in the lifetime of the company, end up to maintain my 20% or something, I have to put in $15 million. Well, if I'm a small fund and I can't afford to write $15 million for one company, it's a non-starter for me. So being able to understand what the longer-term capital needs are to get to beyond cash flow break-even is really important. And finally, your investment potential. So this is, why are you a good investment? This comes back to that competitive differentiation thing that I was talking about earlier. And that's why I said it's so important, because that's the way we think about it from a value creation standpoint also. What are you doing that gives you sustainable advantage over time, and that creates sustainable value at the end of the day for the company? So that could be the customer base that you're acquiring over time. Even if you're not making revenue, but you're attracting a bunch of customers, that's valuable to someone who can think of a way to maybe monetize them later. Twitter is a great example of that. Partner and distribution networks. Maybe you are doing a bunch of business development deals with a bunch of key folks, and that distribution advantage or partnership advantage is kind of you're creating an ecosystem around you, and that's going to be hard for people to replicate in some way. Or those are the potential acquirers for your company. We have a lot of companies that get bought by the companies that they partner with. We have a company that partnered with AT&T and built out their entire Wi-Fi network. It's called Wayport. And so, you see the free Wi-Fi hotspots from AT&T and Starbucks and McDonald's and places like that. That was Wayport's network and capability, and AT&T hired them basically to run that for them. And then eventually they said, hey, we want to own this in-house, and they brought it in. And so you can get bought by your customers, your partners all the time. So that's of value. So being able to show that that's what you're accumulating over time. Or it might be data and content or real estate, like I talked about earlier. It might be that unique technology. It might not have anything to do with this. It might have to just do the fact that you have this great technology that gets better over time as you invest in it more, and that's going to be really hard for someone to replicate. And that's what I'm buying at the end of the day. Or it just could be pure revenues. You're just going to generate a ton of cash. I mean, that's the easiest one. But for early stage companies, they often don't get value on that. They're getting value on these other things. So be cognizant of that and how you're driving towards that, and optimizing your strategy to maximize the one or two that you think is the real value driver. That's important. You also want to talk about your likely acquirers. So, I'm not saying that you should build your business to be bought necessarily, but if you're going to raise money from venture capitalists or angel investors, they are often looking to get their money back at some time through some sort of exit, and that either means the company is bought or it IPOs on the public markets. IPOs are less common these days. Most companies get bought. So it's nice to be, again, cognizant of who might buy you, why they might buy you. It might influence your strategy a little bit, but it shouldn't. I mean, at the end of the day, you're building something because you want to maximize the value creation, not who's more likely to buy you. But if you're aware of that, that's good, because that means that you're relaying to the investor that you've at least thought about it and you understand the dynamics of the marketplace. And if you can find analogies or analogs from the past where, hey, I'm kind of like this company from the last generation of technology that did something similar, and then they got bought for this amount when they achieved a certain size. If you can show that pattern, that is awesome, because investors are always looking, they kind of pride themselves as being good at recognizing patterns and investing based on that. And so if you can somehow articulate that, again, credibly and not in a stretch, and not doing it just for the sake of doing it, but it's something real, then it's good. And it will definitely help you get an investor more interested and excited about the opportunity. So that's it for me. Sorry if I was rambling in some of that. But if you have any questions, that's fine. Yep.
Do you mind sharing that presentation?
Yeah, absolutely. I can do that. Anything else? Yep.
Actually, the first, I think it was the company summary, you said it should be big or something like that.
is, okay, on the long-term vision. Yeah, so again, I'm sorry because I'm giving you the perspective, and I should have kind of started this. I'm giving you the perspective as a venture capital investor, which is someone who half the companies fail because they're so early stage and high risk. And it's kind of like video games and movies, and a couple of them do really, really well and make up for all the losses. And so in our success scenarios, we're looking for companies that can get really big in terms of revenues, or getting bought for a high price, even if they don't have that. So, you know, the initial, what you're going to do in the first year strategy is interesting, but we're always thinking about what are you building towards, you know, and what do you imagine you can become from that initial strategy. And so we like to see that kind of ambition and that story. That being said, I can't speak for all of your business plans, but I'm guessing some of them are going to be maybe lifestyle businesses, where, you know, by lifestyle businesses, I mean, maybe you're not going to raise outside money, or you may raise a little from friends and family, and it's something that can, you know, pay the bills, and you'd be happy. It may grow, but it's not going to necessarily explode really quickly, like venture capitalists are looking for. In which case, that might be not as important. And a lot of the things I said may not be as important. I'm giving that perspective for kind of what we call high potential ventures that can get really big. Yeah.
Do you recommend writing the executive summary with the bracketing points?
In this order or in bullets, is what you're saying?
Yeah, bullets would just each the 8 points and then paragraphs.
Yeah, I think sections are absolutely important. You know, I think for the purposes of this academic exercise, you know, it'd be good, since people are going to be judging you based on this scorecard, I don't think it hurts to make it clear that you're, hey, now I'm talking about this, so you can, you know, but, you know, I wouldn't necessarily say you have to use all of these, or you can combine a few of them. And you may present them in a different order, so actually, I had added in my appendix here. I like, this is what we use for, what I recommend for slides, for presentations. I stole this from one of my favorite venture capital bloggers, but, and this kind of almost lines up pretty well with what we were talking about earlier, but, you know, I think this is also a very good order in which to talk about things. And it's very similar, but, you know, if you don't, for instance, if you don't have much customer adoption or traction, you know, you obviously don't write it for the sake of writing it. As a separate section, you can maybe group that under something else. And you know, it's up to you in terms of which ones are longer and shorter, depending on what you have strength on. You don't just fill it up for filling it up's sake. I think that's the worst of just reading empty text that really doesn't have value. All right. Thanks, guys.